That was quite the finish that we had coming after those FOMC minutes. We did the market; those minutes did come out. There was some chatter about inflation. There was some chatter about tapering, and the market's view that tapering may begin, or at least the announcement of tapering may occur in September, appears to be still in line after those expectations appear to be still in line after this announcement, this FOMC minutes. We had some negative reactions to earnings from the retail sector that also had an impact on risk appetite as a whole. The question is now, have we, really kind of, has this been a trend creator, like a trend? Has this altered the trend? Has it been that, or is it still just noise? So that's the big question that we ask ourselves anytime there's a day like this. Of course, it's always, doom or gloom, or everything is roses when you're looking at it from a media standpoint. But we know that what to look for to see, is it noise or is it more than noise? So I'm going to break that down in our video today. What's driving this? What has the margin of safety if we need to ever look for that? And then for our trade idea of the day, we'll take a look at one of those retail stocks that, again, broke down pretty hard and will give us an opportunity to balance some of our kind of more higher probabilities trades with a home run swing. So let's go ahead and get started. Today is Wednesday, August the 18th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see how we've had a pretty significant drop here. Let's take a look at the market forecast here on this chart. Pretty significant drop towards the 30-day moving average. The momentum line dropping to an extreme low down below the 5th percentile. So that's closing at the lows of the day with the range that we got today. A little bit bigger range, 56 points versus the ATR 32. So, almost double what the normal range is. See the high numbers you have here on a 1-year basis, and but the momentum line dropping to the 5th percentile, the near-term line dropping below 40, so getting into bearish territory. So that's a little bit of a bearish short-term sentiment, obviously. The intermediate line, however, is still above the 90th percentile, so it's not even close to getting out of the upper reversal zone, much less out of bullish territory, which below the 60th percentile, which would signal that we were in any kind of decline, at least the beginnings of a decline. So not nearly very bearish at all for the S&P 500, at least on this chart. Of course, when you look at the Dow, we did get a yellow line, so we did close below the 30-day moving average, and the same thing with the short-term sentiment. If you look at the NASDAQ composite here, let's look at the NASDAQ at 100. There we go. We'll look at the NASDAQ 100, and you can see, again, same thing, like we are getting a little bit of a decline here. The yellow line, dark green shading, because we're still nowhere near getting below 60 or 50, even if we are getting some extreme lows on the momentum line. And then you can see the Russell 2000. We are getting, we are back below 50. We are working our way back towards being below 40 again, which is when you're in bearish pullback mode. It's done that a few times here, and this time we made a bullish run without getting into bullish territory and rolling back over. So still within yesterday's range on the downside, so we didn't get a new lower low, but still a pretty bearish pattern here with dark pink shading and a red line again on the Russell 2000. When you look at the long-term chart here, you can see that you still have a very high PPO here, nearly at 8, but it is dropping, and you can see a little bit of a neutral candle developing. Now, we've had neutral candles before on the SPX, so this is hardly surprising at all. It is, once you start looking at the Dow, you see the NASDAQ. Again, we'll look at the NASDAQ 100 here. You can see the NASDAQ 100 all look very similar until you get to the Russell 2000, which again has been on this bullish convergence this entire time and is below a falling 50-day moving average still. And so, much different scenario that we're seeing playing out. Here's the kind of the big change today for the S&P. We closed really close to closing below the 30-day moving average. Remember, the Dow Jones did, so the Dow Jones fell below the 17 and the 30 today, and then the So that would be the index. And then the QQQ, as you can see, also it broke below the 17 yesterday, breaking below the 30 today. Still up above the 50. You can see we're still on a bullish convergence. We haven't like gone bearish here, and we are still, above the 50-day moving average, which will act as a kind of another layer of support in addition to the Fibonacci line. See that 23% retracement is way down here. But there is a wide gap between the 50 and the 200, so there is an opportunity, if we do get bearish, that we can fill in a pretty wide gap here. And this obviously would need to go up a lot higher, up into this area. But you can see that there's a pretty wide gap to the 200-day moving average if we break down, which remember we have on IWM. In fact, IWM is flirting with its 200-day moving average as we speak, and its 200-day moving average is actually at the 23% retracement. So, I mean, there's some, there's multiple layers of support here on IWM. It's, again, small cap stocks don't run the market. I mean, I think everybody and their dog has been saying that on Twitter about how small caps they're not reflective of the broader market. No, but they are a risk asset class. People willing to take risks put their money in small cap stocks. They don't put their money in small cap stocks because they're, let's say they're in the NASDAQ 100 right now, the Qs, and because they're looking for good returns, and now they're worried about returns there, and they're like, well, let's put it in the small cap index for a safety. They don't do that, right? It's another risk asset class. So this particular risk asset class is being a little bit reflective of risk in general. Now, you notice we are below the lower Bollinger Band. We're not below that 23% line yet. You also notice, too, that we are not below the Keltner channel yet. The Keltner channel also happens to be right at that 23% retracement. So breaking below 212.5 will be significant. Very, very significant for this risk appetite in general. Like back here in June, if you look at, so you notice here back in June, IWM, right, the day before expiration, we were nowhere near it. But that wasn't the case for SPY. SPY, that day before June, we were actually, relatively close. But the interesting thing about that day on SPY is on the day before June expiration is that we had closed down below the 17-day, right here, the 17-day, the 30-day, and the 50-day all at the same time. So you think, dang, that was really bearish. That we could have been really set up for some bearishness there. But you notice we didn't get below the Bollinger Band or the Keltner channel that day. We came really close to the Bollinger Band but we didn't get below that. And you saw with IWM, we weren't even close, right, going into that. So, nor we were anywhere close below that 23%. So you see why we weren't necessarily set there to break down. But if you break down now below this level, then, and you saw where the two-line versions are for SPY here, how close we are to that 50. If we break, which is well above the 23% retracement. So if we break below all that support on the IWM, it most likely won't be a causation. It's not a cause and effect, but it will be a correlation, a reflection of broader risk aversion. Because I think if that were to happen, we would probably be breaking below the 30 and the 50 at the same time. Now, it'd probably take that kind of a day. Now, I don't know if that's going to happen tomorrow. In fact, I highly doubt it's going to happen tomorrow. I think we actually will get a pretty decent bounce off this this selling today. So that's the most likely scenario. But that's the kind of drop it would take. If we did get a drop below the 30 and the 50 tomorrow, and a drop below all that support on small caps, then we are in pullback mode, like broadly. Now, we will be starting an intermediate drop. I mentioned to you before that getting that kind of a gap will be kind of an indication that we might be starting there, but getting a drop below 2%, that's going to be the biggest tell that we are now starting. And obviously we haven't had that drop below 2% yet, nor have we had that on IWM either. And you also notice too that the VIX, the volatility index, is still, before this late push higher, we were actually in my class in our options inventory trading talking about how low volatility was, and we're looking at calendar spreads, and boom, look at the volatility jump all the way up to the 90th percentile. In fact, interestingly enough, the VIX here, when you look at the VIX on this particular chart, and I don't normally do this, except for when you do close above the 200-day moving average, normally you can see it's pretty bearish for volatility. So unless we change, right, unless the trend changes on this, which the last intermediate pullback we had was over here, even there, that day that we closed in September, really it was back over here. And by the time we closed above the 200, all these lines were rising. The 8 and 17 were above the 30. They were all above the 50. And then we broke above the 200, and we were kind of in pullback mode, and something similar over here too when we were in pullback mode. So until then, all these other piercing of the 200-day moving averages, when all these lines have been kind of in the right order below the 50 and all that, that has led to. The only difference now is, the 30 is above the 50, the 8 and the 17-day are above the 50, and potentially moving above. So we might be getting, I just don't think we're there yet. I think we're getting closer, but I don't think like this is the day that we will like turn things around and start the pullback. I think this will be an opportunity for us to sell that jump in volatility, at least again in the very, very short term. If you look at the 4-week range here, right here, there's the drop in SPY closing at the low of the day, but look at all that volume right here on the 4-week chart. That's where the point of control is. So there's a lot of volume here for us to, now if we break down, you can see there's not very much volume, but we're not breaking down. So there's an opportunity for us to be pretty bullish off of that support. You expect support to hold until it doesn't, right? And then if I look at IWM, same thing. We got a new low yesterday, and that gave us a bearish Arun indicator here. You got a new low yesterday, but to 100. But so that's bearish. But again, we're not breaking down yet. We are at the lower end, and you notice how the range for IWM is really tightened up significantly. Like before that low point, but here if I go back to 30 days, you can see there's the 20 days that we were at, and you can see that we had this low that we're now tightening up here, and you see the same thing on SPY too. We had that low, we're starting to tighten it. We're going to really tighten it up on SPY and start to move this up significantly, that low point. In fact, it's going to move up eventually up to this area here, 436, 11-point move on a 11-point range on a 447 high. That's about 2.5%. That's a really, really tight range, and could lead to a breakout type of move if we were to break through these lows here. So we're not there yet. There's more of a chance that we'll bounce up tomorrow than not, especially off of those extreme lows. But the extreme low on the market forecast indicator, that extreme low there does, to this 5th percentile here, does suggest that we might be getting, especially coming off of a cluster, no less, a double cluster just 2 days ago, to then now drop to an extreme low, does suggest that we might be closer to the end. You can see again, this was an intermediate pullback on the NASDAQ, and we did go from a near cluster to an extreme low, and that started the pullback on the NASDAQ. Over here, you got the cluster. You went down to an extreme low within the next Monday after expiration, and that started that intermediate pullback on the NASDAQ. Didn't quite get there on the S&P, but on the NASDAQ it did, both of these times. So here we are again, clusters, and dropping to an extreme low just a couple of days later. Could that signal that we are in intermediate pullback mode? And will this one be a lot broader than what we've seen on the previous ones that have been related just to the NASDAQ, just to the Dow, just to the Russell, as we are on right now? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, it tells us you want us to do another video again tomorrow. Quick way to give us feedback if you like our videos and you want to let us know. If you don't like them, of course, you don't have to click on anything. You don't even have to watch. But if you like it and you want to let us know, those go a long way for us. So go ahead and give us a click down there. You can do that right now while you're watching. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Our free subscribers get a unique offer to check us out. So subscribe there. See what that offer is for you. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog here, come down and check out some of the other things on this page, including our Market Outlook live video. Here's where I review all the trades that we've been doing. We put on today's trade idea already before the market closed. I did it during this live video. This is where you can see it, or you can come up here and click on Market Outlook Live Trade Review. Also, all of our upcoming trading rooms are over here on the right too, and you can see the rest of them by clicking on trading rooms. Of course, all of our paid subscribers get access to all of our trading rooms and the Market Outlook Live videos. Of course, our premium subscribers pay less per month than our Plus do, and as well as, in addition to that, our premium subscribers also get access to our class forums with the content there and interaction community with other class members, as well as all of our premium tools and resources here. Come down, click on this heart, opens up a new tab. Click on this like button right there. Also click on this icon, opens up another new tab. And click on that like button as well. Again, same thing. It really helps us out because Twitter and Facebook will promote our content that has engagements, has likes, to more of our followers that actually follow our accounts. As you can see, there's a lot more people than 68 that followed my Facebook page. But just, the more likes, the more it does that. So if you come over here, it also benefits you, because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at how these asset classes perform. You can see over the last 3 months what the biggest winners have been, what the big losers have been. But let's just look at today alone. And this will be an interesting chart because most of the losses occurred at the very, very end of the day. You can see when to this point, about 12:30 my time, with an hour and a half left to go, emerging markets were pretty good, almost 1% higher. In fact, they were 1% higher with 2 hours to go. This is right when the Fed minutes were released. Right, the IWM was up at its high of the day. International stocks were up at their highs of the day. The Qs were at the highs of the day. Retouching some highs from earlier this morning. But since the Fed minutes were released, blammo, everything dropped. Commodities were already down pretty sharply, along with real estate. They went down further. U.S. stocks, all U.S. stocks. In fact, U.S. stocks have underperformed a lot more than internationals did today. And I think, if and when there is any kind of exhale on an intermediate or even a market sentiment basis, there's a much more, the international stocks have a much better margin of safety than the U.S. stocks do. In fact, when you look at the long-term crossover chart here for S&P, you can see a very strong PPO still. But if you look at EFA, not so much. So we've already been converging and slowing down. When you look at EEM, even more we've converged, and we're actually trading below the 200-day moving average, or the 40-week exponential moving average. When you look at it on this chart here, you can see emerging markets had been below there. They dropped below the 200-day moving average over here and hit that 50% retracement level. Came back up and flirted with their 17-day, 30-day. Now they've all crossed below the 200, and now the 50 is about to cross below the 200. So, we're still trading below that 8-day. Things are still bearish on emerging markets, and they've already come down past their 38% retracement of that same move off that same low point when everything else hit their lows. And if you look at EFA, it's kind of similar, that it peaked here earlier and it's already been converging and trading, made a run back up, but it's already been below its 50-day moving average. And again, if I draw the same Fibonacci retracement lines off of that Halloween low point where everything kind of bottomed out, we flirted with the 23% line over there, and it looks like we may be on its way to doing that again. So again, you see how that margin of safety, like for EEM, it's already had this decline, and it's already kind of pulled below some of the supports, got less left to drop. This 38% retracement on the long term, the post-COVID low, we're actually pretty close to it at 47.5. That's not the case for SPY, right? There's the 38% way down there, or nor is that the case for QQQ. The 38% line is way down here for the market, for that market sentiment run that we've been on. So much poorer margin of safety, even to get down to the point of control. A much poorer margin of safety for the NASDAQ on a long-term basis, and the S&P and U.S. stocks in general, than the international stocks. If you take a look here, you can kind of see it too on this chart. We look at these in my portfolio management class. We look at these ETFs. So you have the U.S. equities, which are breaking below the 50-day moving average. This is the ETF that kind of tracks. This is everything. So there's a VTI breaking below the 30-day moving average. You saw VT, which is everything, kind of an ACWI type, breaking below the 50-day, the 30 and the 50 at the same time. And then here is the international version of VT. And you can see being below that 30-day, holding the 50 for some resistance and rolling over, and trying to fill in that gap. So, again, not as already more bearish than already more bearish U.S. equities, or international equities have already been more bearish than U.S. equities. When you look at it here, you can see it too, VTI relative to VXUS. See how strong U.S. stocks have been, and here let's zoom out for some perspective on this. You see how strong U.S. stocks have been, and how strong they've been lately, and they at the beginning here in July is when it really peaked, and it's been diverging with a little bit of a head and shoulders pattern. You can also see the divergence. So that's let me zoom back in so you can see the head and shoulders there, head, the shoulder, head, shoulder, the divergence of the MACD, the divergence on the CCI and the RSI, and the ability, the opportunity for U.S. stocks to underperform international stocks going forward from here. You also see that too when you look at like here VTI and VXUS relative to VT, like the total. It's really raining hard out there right now, and I live in the desert, so that's a significant thing. So there's on the daily chart, VTI has been underperforming VXUS, but here's the weekly, the kind of longer term view. Look how strong VTI's outperformance has been, how weak VXUS has been. I mean, they're about as extreme in opposite directions as they could possibly be, and that would suggest and lead you towards a rotation, right? A rotation down to the left for VTI, up to the right for VXUS. This is what VTI looks like, again, when you compare it down here to VT. Put VT on this one too. This is the total international. You can see the strong relative strength. That's how strong we've been. This is on the daily. That's on the weekly chart. So you can see that relative strength up there. You can see the relative strength ratio chart here with the momentum. That momentum looking like it may be peaking here. And then this same thing on the opposite side of the equation, VXUS. The still bullish, right? See how bullish it's been, and the opportunity for it to fall, how much it's been underperforming, and how low its relative strength is, and the momentum may be peaking there too. So when I say margin of safety, I mean if there is any kind of risk aversion trade going forward, you can see where the weakness has already been versus where the weakness may be going forward from here into these areas. Commodities have also been kind of making kind of an interesting move here in general as a basket. There's the commodity index. You can see the everything breaking down below the 50-day moving average here. The 8 and the 17, the 30 sitting right on it. So we have been converging for so long to that 50, and now breaking down, and you can see how wide the gap is to the 200, which is sitting right around the 38% retracement of that Halloween, this intermediate run that we've been on since that Halloween low. You can see the divergence, or the bullish convergence since that big strong peak on commodities, that kind of secondary peak. We had this first one here, and then peaked a little bit later, and then kind of this secondary push of, in fact, stronger momentum than we had initially when we started this. And then now we've been converging ever since, and potentially now rolling over towards that low end of things. Here's the Bollinger Bands. Well, let's take a look at the directional movement index for commodities, and you can see the kind of breakout type move above 30, working your way down below 20, and the potential that it has, because we are extremely low on the ADX on commodities. There's your breaking below the lower band and almost breaking below that Keltner channel there, and giving us what could be a green dot on a bearish move, right, with a bearish momentum move down here. So that's something to watch over the next day or two to see if by the end of the week we get the bearish breakdown in another risk asset class. Let's take a look at the Euro US dollar and see what it's doing. So it's had an interesting reaction to the Fed minutes. It really dropped, so the euro kind of hit this high, but then it rolled back down, finished the day. I didn't think it would. Initially, right after the Fed minutes, when this pair took off, the dollar dropped. I didn't think we'd finish the day with a cluster. But after getting extreme low yesterday in the momentum line, now we have all four lines. So this cluster, we didn't quite have the market sentiment line down there, but now we do have all four lines down below there. So that's an opportunity for either one of two things to happen. Either we bounce off this really strong support to the upside, or we have an opportunity to break down further down towards 113, if 114 area, where the long-term trend line sitting and the bottom of this Fibonacci retracement zone. There's also a couple of touches in that area too. I mean, that's kind of where the next layer of this really strong support can be, and that, if we make that kind of run, that will again be on a broad risk aversion trade where the market will be looking to move into safety, the dollar in particular. Here's the long-term bonds making a run into bearish territory, getting a bullish signal, and we are bouncing back up. The intermediate line did not get into bearish territory. Instead, it stopped and is now potentially rolling back up towards bullish territory. You notice we didn't get very far below the moving average here. Very similar to what we had over here. So it looks like even long-term bonds is making a new run. Let me show you where those lines are coming from. So this here, let's get rid of this long-term one for now. There's the current intermediate run that we've been on since November. On the long-term bonds, you can see where the 62% retracement. So I've kind of pointed to this area before, but I think if the dollar makes that run higher, the euro US dollar makes that run lower on any kind of broad risk aversion trade, that would mean long-term bonds are working their way up here towards 155.5. That would put the yields working their way back down probably towards 1% again, before it finds some pretty significant support on a retracement basis at that level. And you can see the intermediate line unable to get back into bullish territory there before rolling over. One of the biggest movers of this risk aversion today was the retail sector. Lowe's and Target having earnings. Target really struggling with its earnings, at least the market. Now keep in mind that the market has been buying Target up like crazy since its last earnings. So it's, just because you can't look at the market's reaction into an earnings announcement to see, well, was it a good earnings or not. You have to look at the market reaction in context of how it priced in the earnings announcement, and to see, well, maybe it priced in too much prior to this. So it's not a bad announcement. It just might not, the market might have priced in more than what it actually got, which is not a bad thing because the market's not always right? Nobody knows what's going to be coming out and can run into a trend, and that's what Target's been doing. Target's been on this insane trend, so bullish, right? If you look at its long-term chart here for Target, you can see we're breaking below the 50-day moving average today. And remains to be seen if we'll finish the week there, but I mean 17% is its PPO. The market itself is 7 3/4, so it's a very strong long-term. Like it's that gap is huge. It doesn't look huge, but when you look at this number relative to where the market, the S&P is like right here. So it's a very, very bullish. Target has been, and you can see here that we are now. Target is flirting with breaking down below. Well, in fact, it did finish at the low of the day, closed below the 50-day moving average one day after closing below the 30-day moving average going into the earnings. The MACD is turning negative. The MACD hasn't turned negative for a long time since that February-March pullback where kind of the NASDAQ had some risk-off moves. This is the first time that it got below the 50-day moving average and stayed down there for a while, and had a pretty decent sized gap to go. Very same thing, very decent sized gap. I mean, we can go down to 222 easily because there's very little volume in this area as well. If you look at the Bollinger Bands, there's very little volume in this area between now and say this 222 area where the 38% retracement level is. The 200-day moving average is well below that, down about 200. So there's nothing holding it back. And if you notice, you see that it's breaking below the lower Bollinger Band. It's also breaking below the lower Keltner channel. So that's a pretty significant bearish breakout here for Target, with the Bollinger Bands really tight, very, very low bandwidth, with the potential that we might expand and make a directional move. See, it's been on such a strong bullish directional move that the ADX is still really high. And we've already turned bearish, and we're close to being above 30. We're already down well below 20, so there's an opportunity with volatility with that so high that we can maintain a very strong move just in the opposite direction now. If you look at the RSI and the CCI, the RSI breaking below 40, the CCI breaking below negative 200. You see it hadn't broken below 100 this whole time, so very significant breakdown. And so considering in our portfolio here, in our on all the previous trades that we have a pretty decent positive delta and positive vega and a lot of positive theta. I thought, well, hey, here's an opportunity on the stock, and if it bounces up, I can do a low risk trade and try to speculate on a bigger downward move and give myself some negative deltas to go with all these positives. Give myself some negative deltas. I got a lot of positive thetas. I can do a negative theta trade. So basically, what I'm going to do is I'm going to buy a put. I'm going to put it with a short put at 2. So I'm going to cap my gains off at 230. But I'm going to buy this 240 put, a little bit out of the money. Sell the 230 put to reduce the cost a little bit. In fact, it reduces it a lot. So now it's actually a really low risk trade. But if this trade does work out as we anticipate, and you can see I've already put it in today before the market closed, and the stock's already down from when we got into it. It looks like we were into it at about 249, and the stock is down to 247. Now, granted, it's in the after hours, and it's kind of still staying in that area, but we can easily bounce off of that 50-day moving average, right? So, but if it does keep dropping, if it does, we get a low risk. But if it keeps dropping, I got a really good reward, because remember, to 220, there's nothing in here that can hold it up. The 200-day moving average is at 200. The 38% retracement's at 220. So there's a lot in low volume. There's a lot of just no volume, because we've been so bullish that when you go up a lot really fast with low volume, you can come down the same amount really fast, the same speed, because of the lack of volume. So if that happens, we can get a good reward for the risk that we're taking on this trade. All right, well, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. All of our subscribers, even our free subscribers, have access to that forum. So open up any new threads there, reply to other people's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, like us on Twitter and Facebook as well, comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.